Scene script. Have you ever wondered how to make money with stock options? Well, let's start by understanding what stock options actually are. Picture a contract, an agreement of sorts. This contract gives you, the buyer, the right, yet not the obligation, to buy or sell a stock at a specific price. We call this specified price the strike price. But there's a catch. You need to make this decision on or before a certain date, which we refer to as the expiration date. Now don't get overwhelmed. Just remember, with a stock option, you're buying the possibility, the potential for profits. You're not directly buying the stock itself. It's like having a reservation for a seat at a concert. You have the right to that seat, but you're not obligated to show up. So, are you ready to unlock the secret of making money with stock options? Let's dive in. Now, to make money with stock options, you must first understand what calls and puts are. When we delve into the world of stock options, two fundamental types emerge: call options and put options. These are the building blocks of many strategies that traders use to make profits or hedge against losses. Let's start with call options. Imagine you're at an auction and you see a piece of art that you believe will be worth a lot more in the future. You don't have the money to buy it right now, but you're willing to pay a small fee to reserve the right to buy it at today's price in the future. That's essentially what a call option is. It gives you the right, but not the obligation, to buy a stock at a predetermined price, known as the strike price, within a certain time frame. If the stock's price rises above your strike price within your time frame, you can buy the stock at the lower strike price and sell it at the current higher price, pocketing the difference as profit. Now, let's flip the scenario. Imagine you own a valuable piece of art, but you're worried its value might drop in the future. You'd like to ensure you can sell it at today's price, even if the market value falls. This is where a put option comes into play. A put option gives you the right, again, not the obligation, to sell a stock at a predetermined price within a specific time frame. If the stock's price falls below your strike price within your time frame, you can buy the stock at the current lower price and sell it at your higher strike price, making a profit from the price difference. So, in essence, a call option is a bet that a stock's price will rise, giving you the opportunity to buy low and sell high. On the other hand, a put option is a bet that a stock's price will fall, allowing you to sell high and buy low. With this knowledge, you can make informed decisions in the stock options market. So how do you make money with call options? Well, let's dive right into it. Firstly, let's picture a call option as a ticket that gives you the right to buy a specific stock at a predetermined price, known as the strike price. This ticket is valid only until a certain date, known as the expiration date. It's like a reservation at your favorite restaurant. You pay a small fee up front, and if you decide to show up, you'll get your table at the agreed price, regardless of how busy the restaurant might be that night. Now imagine that you anticipate a certain stock's price will rise in the near future. You could buy the stock outright, but that could be expensive, especially for high-value stocks. Instead, you decide to buy a call option. You pay a premium for this right, which is considerably less than the cost of buying the stock outright. Fast forward a bit, and let's say your prediction was right. The stock price has indeed risen. Now your call option is worth more than when you bought it. You have two main choices here. You can exercise your right and buy the stock at the strike price, then sell it at the current higher market price for a profit. Or you can sell the call option itself at a higher premium. Both options have their own perks. If you exercise the option, you're making a direct profit from the stock price increase. But if you sell the call option, you're making a profit from the increased premium without ever having to buy or sell the actual stock. This can be a great strategy for those who want to profit from stock price movements without the need for a large upfront investment. Remember, options trading is a game of predictions. The better you become at anticipating market movements, the more profitable your call options can be. But, like all investments, options come with risks. It's important to do your research and understand the market before diving in. That's how you can profit from call options. But what about put options? Don't worry, we'll cover that in the next scene. Stay tuned. Now, let's explore how to make money with put options. Put options in essence give their owners the option, but not the obligation, to sell a specific amount of an underlying asset at a predetermined price within a certain time frame. The underlying asset could be stocks, bonds, commodities, or even real estate. But for simplicity, let's focus on stocks in this discussion. To make money with put options, you need to buy them when you predict that the stock price will fall. Let's say you're keeping a close eye on company A. which is currently trading at $50 per share. You believe that due to certain market conditions, the price will drop to $40 in the next month. You then buy a put option that allows you to sell the stock at $50 within the next month. Now let's say your prediction was spot on and the stock price falls to $40 per share. As the owner of the put option, you have the right to sell the stock at the original price of $50. This results in a profit of $10 per share, minus the cost of the put option, of course. But what if you don't actually own any shares of Company A? Well, that's the beauty of options. You can still profit by selling your put option at a higher premium. As the stock price decreases, the value of your put option increases. So you can sell the option for a profit before it expires. However, remember that just like call options, put options also involve risk. If the stock price doesn't fall as you predicted, you could lose the entire premium you paid for the put option. So it's crucial to carefully evaluate the potential risks and rewards before buying a put option. So now you know how to make money with both call and put options. Let's look at some strategies to maximize your profits. As with any investment, having a strategy is crucial when trading stock options. Firstly, let's talk about buying options. This strategy is the most straightforward. You can buy call options if you're bullish about the stock, or put options if you're bearish. The beauty of this strategy is that it offers a limited downside risk. The most you can lose is the premium you paid for the option. Next, we have selling covered calls. This strategy allows you to earn income in the form of option premiums. Here's how it works. You first buy a stock, then sell a call option on that stock. If the stock price stays below the strike price of the call option, you keep the premium. But remember, if the stock price goes above the strike price, you may have to sell your stock at the strike price. Then there's selling naked puts. This strategy is for those who are bullish on a particular stock and wouldn't mind owning it. By selling a put option, you're agreeing to buy the stock at the strike price if the option is exercised. If the stock price stays above the strike price, you keep the premium. However, if it falls below, you'll have to buy the stock at the strike price, which could result in a loss. Lastly, we have spread strategies. These involve buying and selling options of the same stock concurrently. The most common types are bull spreads and bear spreads, which are designed to profit from rising and falling markets respectively. These strategies can help limit your losses while still providing a chance for profit. But no matter which strategy you choose, risk management is paramount. It's not just about maximizing profits, but also about minimizing losses. Always be aware of the potential downside and be prepared to adjust your strategy as market conditions change. Remember, the key to successful trading is not only about making profits, but also effectively managing risks. To recap, we've learned quite a bit about making money with stock options today. We've explored the fascinating world of stock options, revealing that they're not as daunting as they might initially seem. We've unraveled the mystery of calls and puts, showing you that these are just terms for buying and selling rights. We then delved into how to generate income with call options, where you anticipate a rise in stock prices, and put options, where you expect a fall. By strategically buying and selling these options, you can potentially reap substantial profits, even when the market is on a downward trend. Moreover, we've discussed strategies to maximize your earnings. Remember, it's not just about making quick money, but about consistent, informed decisions based on market analysis and well-calculated risks. With this knowledge, you are now better equipped to navigate the world of stock options. Happy trading!